Michael Milken, The Rise and Fall of Wall Street's Junk Bond King. What happens when a financial innovator, celebrated for unlocking trillions in markets, crosses the line into bending the law? The story of Michael Milken, known as the Junk Bond King, is a high-stakes tale of ambition, innovation, excess, and scandal that reshaped Wall Street and corporate America. Milken's name is synonymous with high-yield bonds, better known as junk bonds, a concept that revolutionized corporate finance starting in the late 1970s. These were bonds rated below investment grade, meaning they carried higher default risk. Traditionally, banks and conservative investors shunned these securities, labeling them junk. Yet Milken saw opportunity in risk. He wasn't just selling bonds. He was rewriting the playbook for how companies could access capital. To understand why this mattered, consider the financial landscape of the 1970s. The U.S. economy was grappling with stagflation, persistent inflation paired with sluggish growth, and banks were tightening lending standards. Capital was precious, but increasingly inaccessible for smaller or struggling companies. Enter Milken at Drexel Burnham Lambert, a mid-tier investment bank on the fringes of Wall Street powerhouses. Milken joined Drexel in 1969, and by the mid-1970s, he was heading the firm's high-yield bond operation. What he built was unprecedented, a vast, laser-focused network buying and selling bonds for companies the mainstream market rejected. By 1985, Milken's division accounted for about 70% of the high-yield bond market, a market that went from $10 billion in bonds outstanding in 1978 to nearly $100 billion by 1986. But how exactly did junk bonds work, and why did they matter so much? At its core, a bond is a loan. Investors buy bonds issued by companies or governments, receiving interest payments until maturity, when the principal is returned. Safer companies issue investment-grade bonds. Riskier firms get lower ratings and must offer higher yields to attract investors. Junk bonds, rated below BBB by Standard & Poor's or BA by Moody's, had high default risk but also promised substantial rewards. Milken's genius was twofold. First, he convinced investors to accept the higher risk in exchange for higher returns, using meticulous research and statistical analysis to demonstrate that default risks were often overstated. According to academic studies, including Michael J. Bates, Todd Milborn, and Earl Davis's 1998 work, Milken's smooth diversification of junk bonds reduced overall portfolio risk, contradicting conventional wisdom. Second, junk bonds unlocked a new source of capital for companies outside the investment-grade universe, enabling leveraged buyouts, LBOs, recapitalizations, and significant corporate restructuring. By providing capital through bonds rather than equity, companies could grow or reinvent without dilution of ownership. This innovation fueled the dramatic rise of corporate raiders and private equity in the 1980s, with firms like Kohlberg Kravis Roberts, KKR, orchestrating landmark buyouts such as RJR Nabisco's $25 billion deal in 1989. Milken's work seemed like a win-win. Companies got capital, investors enjoyed outsized returns, and Drexel Burnham Lambert made billions in fees. But beneath the surface was a growing web of questionable practices. Starting in the early 1980s, the Securities and Exchange Commission, SEC, grew suspicious of how Milken's operation conducted its business. Several concerns emerged. First, conflict of interest. Milken's group was simultaneously underwriting bonds, trading them internally, and providing advisory services, a mix that often led to insider trading and market manipulation allegations. For example, Drexel was accused of churning accounts, excessive buying and selling to generate commissions, and parking stock to hide ownership positions. Second, scalping or matched trades, where trades were prearranged to artificially inflate prices and volume, attracting other buyers. Milken's group allegedly rigged bond auctions and manipulated pricing to create illusions of liquidity and demand, attracting more investors while insiders captured profits. One notorious incident involved the firm's dealing with franchise tax board bonds. In 1986, just as Drexel was rushing to dominate the junk bond market, the SEC started investigating irregular trading patterns and improper disclosures. But the spotlight intensified with the 1988 indictment of Milken on 98 counts of racketeering and securities fraud, stemming from a 6-year investigation led by SEC prosecutor Andrew Searsney. The indictment highlighted insider trading, stock manipulation, and conspiracy to defraud investors. Milken initially resisted cooperating but eventually pled guilty in 1990 to 6 counts of securities and tax violations, avoiding the more serious charges. He was sentenced to 10 years in prison and fined $600 million, which was the largest fine ever imposed on an individual at the time. He served 22 months before being released. This legal saga had seismic consequences. Drexel Burnham Lambert filed for bankruptcy in 1990, marking the end of one of the most powerful investment banks of its era. The collapse sent shockwaves through Wall Street, shaking confidence in the high-yield market and prompting reforms. But what did Milken's transgressions mean for the real economy and for people beyond downtown Manhattan? First, the junk bond explosion had a massive impact on corporate America. By unlocking capital for leveraged buyouts, Milken's innovation accelerated waves of mergers and acquisitions that led to enormous restructuring. While some companies used the capital productively, others piled on unsustainable debt, leading to bankruptcies and job losses. For instance, the leveraged buyout of Safeway in 1986 left the grocery chain burdened with over $4 billion in debt, forcing cost cuts and store closures that affected thousands of retail workers. Similarly, the LBO boom contributed to corporate concentration, reducing competition in multiple industries. Second, the market manipulation and insider trading eroded investor trust. Retail investors who had been drawn into high-yield funds suffered losses when defaults surged. In 1989, the junk bond market suffered a significant setback, with default rates rising from 1.5% in 1985 to over 7% by 1989. This undermined confidence in an asset class that Milken had helped to legitimize. Third, the Drexel collapse triggered regulatory reforms. The SEC and the Justice Department enhanced enforcement of securities laws. Rules around disclosure, insider trading, and market manipulation tightened. Drexel itself became a case study in investment bank risk management failures. Yet in the bigger picture, many financial historians argue that Milken's innovations permanently altered the capital markets. Despite his legal troubles, the concept of high-yield bonds remains integral. According to the Securities Industry and Financial Markets Association, SIFMA, the U.S. high-yield bond market exceeded $1.6 trillion in outstanding debt as of 2020, financing everything from startups to major infrastructure. Moreover, Milken reinvented himself post-prison as a philanthropist and healthcare entrepreneur, underscoring the complexity of his legacy. So how did someone like Michael Milken catalyze such profound economic change, then fall so spectacularly? His story weaves together financial creativity, ethical lapses, and the law's struggle to catch up with innovation. Let's rewind to the 1970s to unpack his rise in detail. Milken graduated from the University of Pennsylvania in 1965, later earning a PhD in finance, a rare credential on Wall Street. His dissertation evaluated the risk and value of high-yield debt, a subject no one took seriously at the time. As an analyst at Drexel, he used quantitative methods to debunk myths that junk bonds were too risky. He argued that with diversified portfolios and rigorous analysis, investors could earn returns comparable to equities with less volatility. This approach foreshadowed the rise of modern portfolio theory. Drexel gave Milken freedom to pioneer. He created a sales force that specialized in marketing bonds to non-traditional buyers like insurance companies and pension funds. His team also developed trading desks that maintained continuous markets in junk bonds, increasing liquidity. But Milken's drive to expand market share led to aggressive, sometimes unethical tactics. He reportedly pressured clients and underwriters, engaged in hidden ownership of securities, and traded stocks and bonds in ways that blurred legal lines. Milken's close relationship with corporate raiders created a feedback loop where junk bonds fueled takeover attempts that increased bond issuance, which in turn boosted fees for Drexel. This alignment of interests increased systemic risk. Government prosecutors eventually pieced together the pattern. Milken was accused of insider trading on shares of companies involved in bond deals, manipulating stock prices to benefit bond positions, and lying to regulators. Among the most famous cases was the leveraged buyout of Safeway. Milken's ability to raise junk bond financing played a key role, but the debt burden destabilized the company, coinciding with falls in share price due to trading irregularities allegedly involving Drexel. In 1989, the Department of Justice's investigation and the SEC's relentless pressure culminated in Milken's indictment. What made the case distinctive was the use of the Racketeer Influenced and Corrupt Organizations Act, or RICO, a statute originally designed to combat organized crime. This signaled a turning point in the enforcement approach to Wall Street misconduct. Milken negotiated a plea deal in 1990, accepting guilt on 6 counts, including securities fraud and tax evasion. Though many higher-profile charges were dropped, the $600 million fine and prison term sent a powerful message to the industry. The Drexel bankruptcy followed soon after, with losses estimated at $1.5 billion for creditors and $750 million in shareholder equity wiped out. Milken's fall was both personal and symbolic. To the public, he epitomized Wall Street excess and greed, the prototype of the greed is good era immortalized in films like Wall Street, 1987. Critics argue his manipulation undermined the integrity of the markets and hurt ordinary investors, while supporters contend his financial innovations expanded access to capital and created new wealth. Looking back, the dual nature of Milken's legacy is stark. On one hand, his junk bond market manicured one of the last great shifts in capital markets, democratizing financing beyond investment-grade blue chips. On the other, his practices showed how rapidly evolving financial innovation can outpace regulation and ethical guardrails. The effects continue today. The 2008 global financial crisis revived debates about risky debt instruments and moral hazard, recalling the lessons of the Milken era. The high-yield bond market remains vital, sustaining tech startups, energy companies, and even sovereign states. At the end of 2020, speculative-grade bonds constituted about 15% of the global bond market, according to Fitch Ratings. But regulators keep a cautious eye on leverage levels and disclosure standards. Milken himself became a major philanthropist, founding the Milken Institute in 1991 to promote medical research and economic policy innovation. His rehabilitation underscores how complex figures can influence markets beyond scandal. In sum, Michael Milken's career highlights the tension in financial innovation between risk, reward, and regulation. His brilliance in transforming the junk bond market freed capital for countless companies and reshaped corporate America's landscape. Yet his legal breaches and manipulation remind us of inherent vulnerabilities in capitalist markets. This is a story not just about one man, but about the evolution of Wall Street itself. The high-yield debt market, born from Milken's vision and sullied by his excesses, remains a critical artery in today's global financial system, financing innovation and growth while demanding vigilant oversight. The lesson from Milken's saga is clear. Financial markets thrive on trust, transparency, and a balance between innovation and regulation. Disrupt the balance and the consequences ripple far beyond boardrooms and trading floors, impacting jobs, companies, and entire economies. Michael Milken's rise and fall remain a vivid chapter in the ongoing narrative of capitalism's complexities. The mechanics here were almost laughably simple, and that's why nobody caught it for years. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Raj Rajaratnam, the hedge fund manager who wiretapped Wall Street. You will not want to miss it. I will see you there.